All right, and Pat, do you want to go ahead and take it away?
Perfect. So, you guys know this, but a quick reminder of what the survey this quarter covered. It was, again, the pulse update, so the same questions that we ask every quarter around utilization, around work on hold. So obviously the quick pulse update, the specific dive this quarter was into headcounts, especially focused on value-add headcounts, and then financial statements, so the profit and loss summaries, manufacturing costs, things like that. So that was the big focus for this survey. Breakdown of this survey, we had 61 responses this quarter, with our pretty traditional split of between 2/3 and 3/4 mold, with the remaining third to quarter dye. So we'll start with the repeated pulse portion of the survey, a quick coverage of the demographics of that survey population. So as we mentioned, the dye mold split, our revenue range split was pretty consistent with previous surveys, pretty evenly split across the ranges, a little bit lighter on the largest shops on the larger end, over 20 million. And the Canadian to US split, pretty similar to the dye mold, about 3/4 from the United States and about a quarter to a third from Canada. So we'll start talking about utilization. So people are obviously very busy right now, but we saw a slight dip in utilization coming from the previous quarter. Felt more strongly on the dye side, but a small drop also on the mold side. When we saw those two groups starting to converge, we would expect the drop to be felt sooner in dye. We oftentimes, they see sourcings a little bit sooner, so if a dip was starting to occur, they'd be the first group to feel it. On the revenue side of things, we saw the largest shops maintaining the highest utilization, and as we dive into some different splits later on, we'll start to see why there's that split in utilization toward the top end of shops. When we break out the utilization by dye and mold, we see the averages are in very similar places. They're right in that 80 to 82% utilization across all the functions, so pretty consistent across the functions. What we see when we dive into those a little deeper, though, when we look at the quartiles, is a similar thing that we saw last quarter, where there's a lot more variation on the mold side of the business, or of the industry, excuse me, in utilization. There's that top 25% of shops that are well at or over 100% utilization. So you see about a quarter of shops on that mold side are under 70 to 60% utilized. So there's a big split in utilization on the mold side, but the dye side has a little bit more concentrated a range of utilizations. And what we see, we can dive into that a little deeper on this next slide. We'll see what's driving that. So what we're seeing on this slide is a breakout of mold utilization, but only for US shops. The same format as the previous one, though, with a high and low quartiles. And what those quartiles mean is, for those red dots in the bottom of this chart, it means a quarter of shops are underneath those utilization levels. And you can see that when you cut it down to just US shops, a quarter of shops are underneath 60% utilized across these revenue ranges. And it's no surprise that the US shops are, without a doubt, having a harder time staying full. And that's driving a lot of that variance in the mold numbers for utilization. So a quick dive into the profit and loss statements, the financials for mold and dye shops. And we don't see a huge variance. The chart on the left is going to show us the cost of goods sold, the selling, general, and administrative, and finally the EBIT, or the profit number for these shops on average. And the averages are very close. I mean, there's a 2-point difference in the profit number, driven largely by your materials costs you can see in the manufacturing cost summary on the right. But again, we emphasize that this is an average. The idea here is that when you dive into the individuals behind these numbers, there's a good amount of variance. There's shops making double these profit numbers, and there's shops that are taking losses currently. So it's important to understand that this is the benchmark, we might say, for these numbers. But at the end of the day, there's a lot of variance here, and there's a lot of shops who are doing great, and there are shops who are struggling just as much. Like we look at every pulse, we look at booked business. So what these charts represent is the amount of business a shop has booked for a particular quarter divided by the reported revenue for 2016. So if I generated $1 million in revenue in 2016 as a shop, and I had booked $250,000 for next quarter, my number would show up as 25%. And what we see is a drop in book business in the previous quarter. Last quarter, the numbers looking forward 4 quarters totaled about 64% of the previous year revenue, which meant the average shop for the next 4 quarters had basically 2/3 of the revenue already booked. When we look at the number now, it's at 44%. So we've seen a decent drop off in the amount of looking forward business shops have guaranteed or booked. And when split up by dye and mold, we see that pain being felt even more so on the mold side. And a lot of this can be attributed to a really heavy second quarter 2017. So when we looked at this chart last quarter, that 2017 Q2 number looking forward was even higher than 22%. I believe it was in the 30% range. The shops had a lot of business going into that quarter, and now those numbers largely are unchanged for the same quarters. So you see shops who had a really heavy quarter and are starting to see it kind of level out or normalize.
Yeah, so we would still view this as pretty positive. Typically, dye is a good indicator with book business of what we would expect to see in the overall industry for mold as well. To add on top of this, Purchasing Managers Index in Canada and the U.S. has continued to stay north of 50, which is positive. So continuing to see a lot of quote activity out there. Book business horizons still stayed over 2 quarters, which is good. So we'll continue to see where this goes as we move forward.
Yeah, and to James's point, these drops from the previous quarter aren't necessarily negative. The previous quarter was just an incredibly busy quarter. So to say a drop from them is, it's a drop from one of the peaks we've seen in the last 2 to 3 years. So not necessarily negative, just a slight decrease. Yep. So work on hold continues to maintain the cyclical nature we've been seeing. It's up from 9.5% to about 11.5%. And again, as we keep enforcing that, these are averages, and we've seen a pretty significant variance here. We got a good number of responses of shops who are between 20 and 30% work on hold, and those are paired with a lot of shops who have pretty normal work on hold levels, 0 to 5%. So those are averaging out to 11.5%. But depending on which programs you're supporting, there are some shops feeling some really significant delays.
And to add on to this, just a little bit, this number can change day over day. So the thing is, we can ask this question every single week and get pretty wildly different results. So trending the overall average can be a little tricky. So we tend to look at the overall kind of macro sense of how the industry is feeling. We're sticking below the historical average of about 13 points. So that's positive, given that a lot of the industry right now is being moved by the automotive industry. So Pat's going to dive in a little bit like what's driving this number, but overall this number is historically low.
So when we split the work on hold number for this previous quarter by dye and mold, we see a small difference, a couple point difference in delays, but from discussing with shops and from what we're seeing, there's 2 really big drivers right now for work on hold. But these are the 2 drivers that are causing these shops to be over 20%, over 25% on hold. And that's going to be the T1 program, and that's going to be the C519 program from Ford. And we're seeing those pretty exclusively on these 2 sides of the T1 driving delays on the dye side and the C519 driving delays on the mold side. So a lot of the shops feeling delays on those 2 sides are feeling them directly as a result of those programs. And again, that's where those averages come into play. If you're not supplying these programs, decent chance you don't have a lot of work on hold. So again, as part of the pulse, we ask about percent progressive terms being provided and percent of accounts receivable being paid on time. Excuse me. Again, a small drop from the previous quarter, nothing crazy, a couple points, but indicates a little bit more hesitancy in the marketplace, perhaps. These are the things that tend to feel the most immediate impact of hesitancy or signs of decreases in the future. These will be the way that suppliers start pulling the reins back a little bit. Again, it's a small drop. It's still at historic highs for the past few years, so still positive, but slightly down from the previous quarter.
Yeah, and it's an interesting one to track, and we've talked about this in the past. As progressive payment terms, any sort of indicator of how well people get paid on time, and typically the answer is no. The lines trend here a little bit the same. However, causation and correlation, we can get into that. The thing is with prog payments, you're typically then invoicing more, but we've always joked it's more along the lines of you're progressively invoicing. So, we've seen this kind of be pretty steady. There is no specific strategy at the OE or the tier level to address this outside of this is just what the market dictates.
Right.
So as the industry is a little busier right now, we tend to see prog payments be a little more prevalent because that's what shops can say, that's what I'm going to get, or you'll have to find a different supplier. So it's kind of an interesting one to track a little bit.
It's really an indicator of negotiating power from the tool shop side in terms of how hard suppliers are working to find capacity.
Yeah.
So again, the overall in the pulses, we ask everyone, all these factors combined, what's your outlook look like? And it's down again a little bit, but still at a high point for the last few years, down 5.8%, which we would still call incredibly optimistic. So shops are still positive about what's coming. Looking forward, still think that these good times, this high utilization will last. So.
Yeah.
So any questions on the overall update before we dive into a little bit of a split of these shops, a little different look at this?
Yeah. If you have any questions, feel free to type them in the chat box. Hopefully you guys can hear us okay. I'm kind of monitoring the chat box on my laptop and then letting Pat kind of run the show on his. So any questions that prop up, feel free to ask. So we brought this idea of primary, secondary shops up in November, and it's an evolution of the tooling supply base that we're seeing. It's a shift in the way the supply base is working. And so we decided this quarter to take a dive into this using the data to see does it support the shift that we're seeing anecdotally in the marketplace. So just a refresher on the idea of primary, secondary shops. On the mold side, what you're seeing is a representation of how the supply chain previously functioned. And basically, the OEMs sourced the projects to their tier 1 suppliers, whose plants kind of then went out and found tool shops that were either on their own preferred tool supply list or that they liked working with, but without any real structure there. It was as the line sort of indicate, kind of just haphazardly being sourced. How we're seeing that shift is that certain tool shops that have grown, that are substantially larger tool shops, we'd probably say largely over the $20 to $30 million range, are starting to change how they function. They're becoming more like a tier supplier, where instead of being allocated a few tools that might match their niche or their capabilities, they'll be provided an entire package. In a lot of cases, they'll be provided a package with target pricing, and they'll have to manage this entire package. So they may not build every tool, but they'll manage the builds of all these tools by outsourcing them to other shops. And those other shops are where that secondary name comes from. So you've got this primary group of really large shops that now have to program manage entire packages, and the secondary shops who stay in sort of similar to their previous function as they build tools to support now tool shops more so even than tiers. So it's a change in supplier for the secondary shops, and it's a total change in business model for the primary shops. Yeah, so we still see tier 1, tier 2, tier 3 suppliers sourcing work directly to what we'll call secondary shops. That can mean a lot of different things. But what we're seeing, though, is more of that bulk type of activity being placed within the primary shop region. Really within the automotive industry, we are seeing this a little bit outside of non-automotive. So this is interesting to kind of track. And then the fact that OEs tend to have preferred supplier networks, they're trying to push this through the tier supply base. That one's also kind of creating a little bit of attention because, if a Ford, for instance, specs a specific mold builder for a commodity, the tier has to be able to say, hey, am I going to accept that or not? And that's something that we're seeing that play out right now.
Right. On the die side, the evolution is probably not as formalized or not as far along, but there's still a similar type of function in the industry where for certain commodities you have these primary shops who function very similar to what they do on the mold side. But with other commodities, you're still seeing the standard model of the tier, just kind of deciding on which shops they want to use and still going straight to those secondary shops. So similar evolution, but probably not as formalized or as far along maybe as on the mold side.
Sure, yeah. The thing is, OEs are good stampers. They stamp a lot of these parts at their facilities, so they tend to have close relationships with Class A surface die shops. And the thing is, we start to see that relationship outside of the Tier 1 base as well. So, we don't necessarily see any changing going on there right now. It's really the moving and the shaking is happening on the mold side.
So what we did was we dove into some of that pulse data and some of the financial data, but we grouped shops by these two groups, by primary and secondary, to see how are they behaving differently, how is this evolution affecting how these shops are running. So we start with utilization, and primary shops have consistently been more full than secondary shops. And as we dive into this, it's not going to be so surprising. What these shops are doing is getting massive packages of tools, and they're outsourcing what they don't want or what they can't build. And when times sort of get tight, these shops have the ability to manage their utilization a little better than secondary shops might, because they have more to pick from. They outsource what they can't build or don't want to, so they have an ability to flex the business they take in more easily.
Yep.
So as you see, even with this most recent quarter, when secondary shops felt a lull, those primary shops actually increased utilization, and part of that's going to be when these shops think a lull is coming, they'll start pulling that work in even preemptively to avoid a lull. On the other side of the equation, and part of why they have to account for this is because the primary shops are more susceptible to work on hold, and the data shows that. These shops are a step closer to the OEM, so they're the ones to feel the delays both most significantly and most quickly. So obviously being in this role has its ups, but it's got its challenges. These guys are more susceptible to work on hold, and they have to account for that in their sales strategy.
Yeah.
And another cost, so to speak, of being of a primary shop is it's less frequent that you get progressive payment terms. Obviously, as the marketplace gets full, everyone's got a little bit more leverage in the marketplace, but there's an expectation on these shops in some cases that's not necessarily there for secondary shops. There's a similar expectation that you see with tiers. We're providing you a large package. Your revenue is high enough that you have a consistent revenue stream, so you can afford to not have progressive payment terms. And to even cascade it further, there's some of these shops that are not receiving progressive payment terms, but having to provide them to their secondary suppliers. Some of these might not be exactly progressive payment terms, as things like covering material costs or some of the smaller shops to lighten the burden. So there's a financial expectation or burden that these primary shops are taking on as they get to a larger and larger revenue pools.
And the question we fielded multiple times over the last 2 years is, what type, what exactly is prog payment terms? Is that a third? Is that in quarters? What exactly is that? We don't exactly look at that right now, but kind of what we're seeing is a broad spectrum, and hopefully sometime in the future we'll look to collect that type of data.
So I'm gonna take a second to unpack this chart because there's a lot going on. But what we tried to show is how these primary shops have to approach the marketplace differently. So what you're seeing is 3 key items stacked for primary shops only, and that's going to be their utilization, their outsourcing, and their work on hold. And the idea is these are the 3 key things that these primary shops have to balance in their business model. Their sales strategy shifts to be one of, we need to oversell capacity to the tune of 110, 120% with 2 key assumptions. One is some of that work may and probably will go on hold, and 2 being for times where the work on hold doesn't bridge the gap to 100%, you can outsource the rest of that work to your secondary supply base. So there's a clear model of oversell capacity and outsource whatever doesn't go on hold that's over your 80 to 90% utilization, which is where shops feel the most comfortable working. And you can see how this is played out over time. And when you stack all 3 of those, clearly these shops are over 120% or around 120% of the work they can take inside, but their utilization has the ability to be managed and to stay a little more flat. And this is kind of the inherent design of primary shops going forward. This is how they have to approach the marketplace. Financially, there's a decent amount of difference in these shops. We see a small profitability difference of about 2 points, and the big driver here for primary shops, their advantage comes in SG&A, so selling, general, and administrative. So these shops have, because inherently they're larger shops, they have the ability to leverage this SG&A better than the smaller shops. These are functions like sales, HR that scale well. So these shops are able to better utilize that, and it's driving those 2 extra points. Whereas the secondary shops have the advantage in COGS. So they're bridging some of that leverage gap in COGS with things like lower material costs. They're building smaller tools. So material is going to be inherently, for most of these shops, a little bit lower or smaller of a line item in their profit and loss statements. And again, we're talking averages here. So there's absolutely secondary shops and primary shops who are making even higher, significantly higher margins than we're seeing here. And there's absolutely shops on both ends making lower margins or even taking losses. So it's not to say that if you're a primary shop, you're going to make more money. If you're a secondary shop, you're going to make more money. There's opportunities to be incredibly profitable, and there's shops who are struggling with both business models. So they're distinct approaches, but it's not to say that one is better or one is worse. So how to wrap this all up? There's been, of course, some small dips in our key pulse indicators, but those dips are coming from an all-time high in the last 2 to 3 years. So we're still feeling this all-time high. Things still look really strong, and automotive forecasts indicate that the next 18 to 24 months are going to stay pretty strong. So we don't see these dips as necessarily indicators of a dip happening immediately. There's absolutely some indications in forecasts that in the next 2 years, maybe there's going to start to be a little bit of a lull. And even despite how much work's out there, there's a divide in shops who are very busy and shops who aren't. There's shops who, on the primary and secondary side, are taking advantage of and adapting to the change in the marketplace. And there's a subset of shops who are struggling to change their business model to accommodate for it. They're having trouble changing their supply base, shifting from their tier 1 suppliers, in some cases, to tool shop suppliers. And if there's people in those shoes who are struggling to fill capacity right now, they absolutely need to take advantage of the next couple of years to shift into this model, because you want to be comfortable with it, you want to be doing well with it when a lull, if it does happen, starts to happen.
Yeah.
And again, profitability is healthy, but we have the same variance. So there's shops who are taking advantage of the good times, making great money doing it, and there are shops who are, of course, struggling to adjust. So there's a ton of there's a divide sort of occurring in the marketplace, and part of it is due to this new development of the sourcing model. So it's shops who are adjusting well and shops who aren't, both on the primary and secondary side.
Yeah. So that was a quick snapshot of what information that we've collected for quarter 2 here in 2017. Now, we'd be remiss if we didn't talk about some of the other industry things that are going on. Namely this morning. With Mark Fields being out as CEO of Ford, so there's a lot of moving and shaking going on. So if you look at within automotive, how has sales been doing in 2017? We're already at a run rate for 2017 that's falling almost 700,000 units short of forecast. So we're currently at about 16.8 million versus a target of about 17.4, 17.5. So, every quarter what we're seeing is that typically cars and things that aren't selling very well are being shifted further and further out from their launch cadence. So, we're in this interesting situation right now of if OEs start to really kind of, get a little sluggish with sales, what's that going to do to the overall tooling market right now? Now, some stuff is so far down the line that, we'll continue to see it. There's some things that are coming down the pipeline, mostly trucks and SUVs, that'll keep the tooling industry pretty busy for the time being. But, right now we're kind of trending towards that situation where sub 17, maybe low 16 million units in North America is going to become the norm. So, if you guys have any questions, feel free to ask. What we'll do is we'll go ahead and, send out this recording and send out the actual presentation later this week. And then, if you have any additional comments or anything like that, feel free to reach out to us. So, thanks for joining us.
I appreciate it.
Yep, we wanted to keep it kind of short and simple. This is what we see in the industry right now. Overall, things look pretty positive, but we're still a little cautious. So.
Yeah, if you have questions after the fact, obviously reach out to us. Our contact info will be on the email. So if you have questions once you're looking back at the deck, feel free to reach out to us individually.
All right. Well, thank you, everybody, and have a great week.
Appreciate it.